Welcome back to this tutorial on financial modeling using Kaluta projection methodology. Last time we ended up in modeling the loan amortization schedule and input the figures into projected financials. Okay. One thing maybe to emphasize is that in the loan modeling, interest payments started to be paid in February 2022, whereas installment for the loans started to be paid in August, okay, due to the grace period requested, so that we will start to pay the loan when the projected cash flow indicates that we can do that. Okay, so when you are given a grace period, that is for paying installments, but definitely the interest starts immediately after getting the loan. So the loan was received in January, and starting from February we start to pay the interest component. So that's what I wanted to talk about. Now let us conclude our financials, because we are done with all the transactions that we wanted to do. Let us now conclude our financials by, let me go to the P&L sheet here. So we have to compute the tax. Okay, so the corporate tax in Tanzania is 30%, so that is what I'm going to use. But when you have a net loss, you don't pay tax, and when you start to have net profit, you will have to cover all the accumulated losses before starting to pay tax. Okay, so they need to be deducted first. So in this projection we see we have negative or net loss up to April, and starting from May we've started to make profit, but it's not enough to absorb all the accumulated losses. We are left with 8.6 million accumulated losses. In June the loss is accumulated loss is extinguished, and in June we are left with 2.1 million cumulative losses, but in July it is extinguished. So we will start to pay tax in July according to this. So how much are we going to pay tax in July? It is the net figure here, cumulative figure in July, that is 11,283,700. Because the net profit we get here in July, we need to deduct the remaining cumulative loss of 2.1 million presented in June, and the remaining figure will be the cumulative profit in July. So that is the figure we are going to tax. So I'm putting a formula here for tax. Double tap to start with, equal to, so my tax will be 30% multiplied by, I'm not going to pick this figure because that will cause circular reference, so I just type the figure. So 13,415,200. Okay, so I enter. That is the tax for July. Now you have after this July, then it's easier for the rest of the month because we have positive, according to these assumptions, we have positive net profit. So it's just a matter of putting equal sign, and then take net profit figure, multiply by 30%. So that is going to be the figure, and I tap to fill this throughout the projection period. Then what I wanted to say here is, if you have understood the process of charging tax after you have absorbed all the cumulative losses, then I could not manage to develop an Excel formula that will compute tax automatically, taking into consideration cumulative losses. That's why I have to do it manually. And because I did it manually, because I have done it manually, then I have to wait until all the transactions that are needed to be input into this projected financials are completed. That's why I made this tax computation the final figure. Otherwise, if I had an automated tax computation formula, I would have done that earlier before. But I cannot derive an Excel formula that will take into consideration that if you have a cumulative loss, you should not charge tax, and you start to charge tax after the cumulative loss is 0, and there is where you have to charge tax. So that is the formula I could not develop, and that's why I have to do it manually. But I know there are experts in Excel formula, they can do that. So if you would look at or even ask in social media, in the groups that are dedicated to Excel modeling, they may help you to develop the formula for that matter. So let us go on, let us proceed now by incorporating these tax figures into our financials. So this one, taxes normally in Tanzania here, the tax is paid on quarterly basis at the end of the calendar quarter. So in this financial modeling, we will accrue tax on monthly basis but pay them on quarterly basis at the end of each quarter. So because we are going to accrue, I'm going to add a section in accrual area because I had my total accruals there. So I insert rows here, insert sheet rows in order to accommodate. Let me select some. Okay, so insert rows, and I can just copy this one. Auditors fees. Yeah, just explanations. To save time, I copy explanations and then I will adjust, paste, and adjust. Instead of auditors fees, it's going to be tax. So this one is going to be tax. and here instead of auditor's fees it's also going to be tax. So we picked tax figure from our projected tax payment and profit and loss. So I start with equal sign, click on P&L sheet, and then go to pick on January where it is. Now because the tax payments draws out cash, I can start with the negative and then pick January, so that my figure there is picked as a negative figure in my computation. So I press enter. Sorry, we are talking about the tax accrual here, so it should be a positive one because we are accounting for accruals. So we start with equal sign and pick P&L and tax figure accrual, which is here, enter. So I tap to fill this because it is true throughout the planning horizon. That is the tax expense component that is accrued on monthly basis in profit and loss statement. Okay, after that, then the cash paid. Now here is where we are modeling the cash payments to be done at the end of each calendar quarter. So in our projection here, the first calendar quarter is March 22 here, and tax paid will be the sum of accruals in January, February, and March. So I can put the summation formula here and then start to sum from January, February, and March there. But because it is cash paid, let's start with a negative number here so that it is going to be reflected like that in our cash flow. So I put negative number after equal sign, negative, and then press enter. Now apply it at the end of each calendar quarter. So I tap to copy and then go to March, April, May, June. So here at June, I tap to paste, and then July, August, September, I tap to paste, October, November, December, here I tap to paste, January, February, March, I tap to paste, April, May, June, here I tap to paste. Okay, to save time, I can just copy from here, from the beginning March here, what we did, select all these computations we have done thus far, that is up to here, and after select then choose copy, and the next one was supposed to be done in September here, so I tap to paste. So I'll be pasting in several places, okay, in December already, in March already, in June already, in September already, in December already. So I can repeat here I can repeat to paste from March here, paste again, and that one will cover up to December, up to March, yeah, until the end. Okay, so we are done. Let me delete this one. We are done with computation, with the projection for the cash payment, tax cash payment. Now let us put the formula for closing balance, which will be the summation from opening balance plus tax minus cash paid. And because the cash paid is negative, so closing balance is just the summation of all. Let me put 0 here, so that when I put summation formula here, it will pick all the, yeah, so that is the summation formula. I tap to fill it throughout our projection period. Okay, and the last thing to do here is the formula for opening balance. So we put equal to, equals sign. So opening balance for February is closing balance for January. So I click on this one and press enter, and then I drag this or fill this to the rest of the planning horizon. After that, then I can now input these projected transactions into our projected financials. So the accrual of tax is already there because we have just picked from P&L. Cash paid, let us go and adjust our cash payment in cash flow, because we didn't add tax payments in cash flow up to now, so we are just doing it right now. So let me go to the sheet relating to cash. Let me slide to I'm sliding to get the sheet here, but I don't, yeah. So here, so in the cash flow from operations here, cash flow from operations section, I will add cash. I double tap to add tax. Tax payments. Okay, so I put a formula here by starting with equal sign, and then go to my working sheet, pick in the tax area here in January, pick here, because the cash paid are in negative, so we don't need to start with the negative number in our formula. We simply pick it as it is. So we enter, and this formula is going to be true, so I fill this to the rest of our projection period. Okay, let me see if my formula for total cash flow from operations also include the tax component. We have just, yeah, it is included. So we are done with the modeling of the cash, and now we have to do it on the balance sheet side. Right now, if we go to balance sheets here, we will see that our balance sheet is not balanced because we have not yet added the tax accrual in the accrual formula in the workings. Yeah, in the workings. So total accrual, we have added tax component. So I click here to add that plus closing balance of tax accrual, which is here. Enter, and then drag this or fill this to, oh sorry, fill to the rest of the planning horizon. So after doing that, our balance sheet should balance. Our balance sheet should balance. So now we are done with our projected financials on monthly basis, and as you can see, it's easier to do this financial modeling on monthly basis, however long however many years you have, because you simply establish a modeling in one area and then you simply drag the formula to the rest of the months. Now, after finishing the months projections, what follows now is to make the annual summaries of these financials, because the annual summaries for projection, the first 12 months are going to be the budget. So these ones needs to be presented on monthly basis. But after that, then the projected financials are normally presented on annual basis. But a good thing with this projection on monthly basis is that it gives you a focus on expected cash flow pattern on monthly basis. Because when you do projection, let me demonstrate by going to even the profit and loss here, in the profit and loss sheet. So you could start with projected sales, and these projected sales could have been seasonal. So you start with January, February, and March. In this case, it was a year zero, that is the setup period, so there was nothing. And then from January, you start to sell. Maybe in July here, the sales are supposed to reduce significantly because it's off season, okay? and maybe July, August, September the off season, and then you return up again from October. It peaks. Okay, so you can model those are real case situations on monthly basis throughout the projection period. But if you do an annual projection without taking into consideration monthly projections, you cannot do those finest computation or finest projection or miniature projections on a monthly basis. You cannot accommodate them on annual basis. Okay, so this is why you need to have your financials put on monthly basis first, and then you can summarize them on annual basis. That is what we are going to do after I finish to explain about our financials, our monthly financials we have here. Okay, so that is one point. The other point is for budgeting. Each year you will need to develop a budget. So if you do it on annual basis, then that means each time you need to after end of each year, you need to break down the annual projected figures into monthly projected figures. But with this approach, you have all the monthly projections throughout the planning horizon. And of course, you will have the annual projection. So when you want, say, the first year has ended, the second year has come, you have already seen the variances, you have done variance analysis, you have established the reasons for the variances, then you can do the modifications on monthly basis, in the figures in the monthly basis, and those modifications will be automatically generated in the summary for annual projections. So it becomes easier for you to do your monthly budget. This fact becomes even true because of the modern variables that makes predictability very difficult. For example, if you take the case of this pandemic, it has caused a lot of business disruptions. So you need to be flexible in adjusting your projected financials as the case needs, and for this matter you need to have your monthly projected figures handy for you to be able to do miniature adjustments on your projections. Okay, so that's the reason why having your monthly projections and then summarized into annual projection is the best approach for you and will make your life easier in future as you do variance analysis and incorporating the needed modifications on your projected financials on monthly basis, and then those monthly bases are summarized in annual. So let us go to see our cash flow after incorporation of all this. So our cash flow has okay, this part for now we do not need because we used it to explain about the working capital and fixed asset component of working capital and fixed asset component of the capital that we had to inject into this business for the purpose of operating it normally. Okay, so Our cash, as we, after all the assumptions we have done, so cash flow at the end of the first total cash flow from operations, we have negative cash flow from operations up to April, and from May we start to have positive cash flow, and according to this business plan is throughout the projection horizon, okay, on the cash flow. Investing, we invested for computers in January, for furniture in March, according to the assumptions we did, and for computers we had to do replacement of fully depreciated computers in year 3, January year 3, so we had to purchase new computer, new laptop, and dispose the old one. So that one gives us the total cash flow from investing activities. Okay, and in the loan we have also modeled the loan, and the assumption of the loan was 15 million, and the loan repayments, so total financing cash flow we have projected there. These are the loan repayments. So that's how our balance sheet is our cash flow statement looks, projected one. Okay, so let us end up here in this presentation, so that the next presentation is going to be summarizing these monthly projected financials into annual projected financials. Thanks for listening. See you in the next presentation.